All right, let's jump right into this explainer, where we are going to put the world's most dominant payments network through an absolutely grueling financial gauntlet. Today, we're putting on our expert investment analyst hats. We're going to systematically break down Visa, ticker symbol V, using the exact unforgiving criteria of Warren Buffett, Peter Lynch, and Benjamin Graham before building a modern discounted cash flow model to see what this absolute financial fortress is actually worth today.
Here is a quick look at our roadmap for today. Visa Snapshot, the Warren Buffett lens, the Peter Lynch lens, the Benjamin Graham lens, modern DCF models, and we'll wrap up with our final synthesis and verdict.
Starting right off with Section 1, Visa Snapshot and Context.
To set the stage here, Visa is a $639 billion behemoth facilitating trillions in global commerce, currently trading right around $336 a share. Now, as of early 2026, it really sits at a fascinating crossroads, pivoting massively toward artificial intelligence and B2B money movement. But the thing that should immediately catch your eye is this. Visa boasts an almost unprecedented 61.48% trailing 12-month operating margin. Seriously, think about that for a second. For every single dollar of revenue Visa brings in the door, over 61 cents drops straight down as operating profit. It is just a complete masterclass in business efficiency.
And that efficiency becomes incredibly clear when we stack them up against formidable rivals. MasterCard is trailing slightly at 57.04%, while PayPal is way back in the rearview mirror at 18.02%. For any investor, this kind of operating leverage is literally the holy grail. It's the absolute engine of Visa's compounding machine.
However, all that profitability is facing a very serious business risk. The reemergence of the Fast-Tracked Credit Card Competition Act, or CCCA, over in Washington threatens those legacy swipe fee revenues. So, it's a classic setup, incredible underlying business fundamentals going head-to-head with a looming regulatory storm.
Let's move on to Section 2, the Warren Buffett lens. As you probably know, Buffett focuses entirely on business quality and economic moats. For him, Visa acts as the ultimate digital toll bridge. It is a pure network of networks. Every time you swipe, tap, or click, Visa collects a tiny fraction of a cent. And because it requires very little incremental capital to scale, it gives them immense pricing power, and arguably one of the widest economic moats on the entire planet.
So if we run the stock through Buffett's strict quality checklist, Visa easily passes. They have highly reliable earnings. Adjusted EPS was actually up 14% to $11.47 in fiscal 2025. Return on equity, exceptionally high. And if we take their annualized net income of roughly $23.6 billion, add back depreciation and amortization, and subtract out capital expenditures, we get massive, highly consistent owner earnings of roughly $24 billion annually. Plus, management has proven to be great capital allocators, returning over $15 billion to shareholders recently.
Now, a crucial point for Buffett is always the balance sheet. He hates excessive leverage, right? Well, weighing their $12.4 billion in cash against $22.4 billion in long-term debt reveals highly manageable leverage for a cash-generating machine of this caliber. Visa passes the Buffett quality test with flying colors. But to actually get Buffett to buy, we'd likely need a 15 to 20% margin of safety on intrinsic value. That suggests a trigger price closer to $280. So right now, it's just a bit too expensive for the Oracle of Omaha.
Next up, Section 3, the Peter Lynch lens. Lynch, of course, is famous for seeking growth at a reasonable price. So we first have to ask how he would even categorize Visa. Are we talking about a fast grower, a slow grower, a cyclical, a turnaround, an asset play, or a stalwart? Well, given its sheer size and incredibly dependable double-digit growth, Visa is the textbook definition of a stalwart.
The absolute key metric for Lynch is the PEG ratio, which is just the price-to-earnings ratio divided by the growth rate. With a PE of roughly 27.2 and an EPS growth rate of about 14%, we get a PEG ratio of 1.94. For Lynch, a PEG of 1 is fair, and anything under 1 is great. So at 1.94, Visa is firmly categorized as a dependable but fully priced stalwart.
While the balance sheet is ironclad, there is another snag in the Lynch framework. He loved undiscovered stocks that Wall Street was ignoring. Visa, on the other hand, has a massive 80% institutional ownership. It is heavily covered. Because of that high PEG ratio and the massive institutional crowding, Visa is simply way too discovered to trigger a classic Lynch buy signal. For Lynch, this is a hold. To make it a screaming buy, the price would need to drop enough to push that PEG closer to 1, implying a target price somewhere near $200.
Moving to Section 4, the Benjamin Graham lens.
Running Visa through Graham's rigorous defensive investor checklist yields some really interesting results. Visa effortlessly clears its hurdles for size, financial condition, and stability. It even passes the dividend record test with a reliable, growing 0.8% yield. But then, it hits a brick wall. Its premium market pricing causes it to instantly fail his strict requirements for moderate price-to-earnings and price-to-book multiples.
Let's see how this data actually builds mathematically into Graham's famous intrinsic value formula to find his absolute ceiling price. We take an annualized EPS of approximately $12.34 based on the latest 6-month data. We calculate a book value per share of roughly $18.53. Then we plug it into the formula, the square root of 22.5 multiplied by EPS multiplied by book value.
And the formula spits out a shocking $71.72. I mean, wow. Because Visa is an asset-light technology network, its book value is incredibly low compared to its massive earning power. For a classic deep value investor like Graham, this is an aggressive sell. Honestly, it perfectly highlights exactly how traditional deep value metrics really struggle to contextualize modern software monopolies.
All right, Section 5, DCF valuation and alternate models. Stepping away from the historical gurus, we've built a DCF fair value matrix forecasting free cash flows over a 10-year horizon. Assuming an industry-standard 8% weighted average cost of capital, which is essentially the return required to justify the risk, and a 3% terminal growth rate to account for their impressive 28% growth in value-added services, our base case DCF points to a fair value right around $325 per share. You can see how sensitive evaluation is to just slight changes in our discount and growth assumptions. Furthermore, when we cross-reference our DCF with comparable historical price-to-earnings and enterprise value to EBITDA models, the fair value range clusters incredibly closely around $330 to $340. What these modern models are telling us is that the broader market has priced Visa almost perfectly at its current value. Which brings us to Section 6, synthesis and final verdict.
It is time to bring all of this together. Our master summary table reveals a very clear consensus. Graham says sell due to a lack of hard assets. Lynch says hold because it's fully discovered and richly priced. Modern DCF and comparables say it is exactly fairly valued right now. Therefore, outside of paying a Buffett-style premium for sheer, undeniable business quality and an incredibly wide moat, Visa is currently priced to perfection.
Weighing the phenomenal, completely unmatched 61.48% margins against the looming regulatory headwinds from Washington, our synthesized expert verdict is a solid hold at current levels. If you want to buy using these historical frameworks, you are going to need some patience. You're looking for a dip to around $280 for a Buffett entry, $200 for Lynch, and a nearly impossible drop to $71 for a Graham entry. Which leaves us with one final provocative thought to consider. Visa is aggressively moving beyond the traditional 16-digit card number. But is their massive pivot to AI, value-added services, and B2B money movement fast enough to protect the greatest profit margin in financial history from the regulatory scissors closing in? That is the ultimate question for any investor looking at Visa today. Thanks for joining me on this explainer, and keep learning.